In the Union Budget 2022, the government had cleared its stand that it is not going to prohibit Indians from dealing in cryptocurrencies but rather to regulate it. Various provisions were proposed in the Income Tax Act to regulate investments in cryptocurrencies, NFTs, and other virtual digital assets. These provisions are applicable from the assessment year 2023-24. Under Budget 2022, the Finance Minister introduced a new section 115 BBH for tax on cryptocurrency and other virtual digital assets at a flat rate of 30%. This section would be effective from 1st April 2022. Adding to the crypto news, the Finance Minister also introduced a new section 149S for the deduction of TDS on transfer of virtual digital assets. Thus, any transfer of a virtual digital asset on or after 1st April 2022 shall be taxable as per new provisions proposed by the Finance Bill 2022. What are virtual digital assets? Why is it necessary to regulate income from virtual digital assets? What are the specifics of the taxation on virtual digital assets? What are the issues with respect to taxation on them? To know all this and more, let us understand all about virtual digital assets in this video. So let's get started. On 4th March 2020, the Supreme Court of India lifted the ban imposed by the Reserve Bank of India on cryptocurrency. The judgment itself did not offer any guidance on regulation, but simply invalidated the RBI circular on the basis that it impinged the fundamental right of those engaged in virtual currency related businesses without providing adequate rationale. The increasing investor base in India has not looked back ever since. Industry estimates suggested that there are 15 million to 20 million crypto investors in India with total crypto holdings of around 500 billion rupees, that is $6.37 billion. Crypto scammers are using a wide range of techniques including identity scams and phishing to lure users into investing through fake crypto exchanges. Investors in India have lost as much as 1000 crores in such scams that are spread through social media portals. The scam involves creation of fake crypto exchanges that resemble legitimate trading platforms. The scammers subsequently reach out to users and offer a $100 credit note as a welcome offer on the platform. Such offers are even credited to the users to gain trust, who subsequently add funds to the platform after making profits. Cryptocurrency exchanges including CoinDCX, WazirX, and CoinSwitch Kuber have been served notice by the Directorate of Enforcement as part of its ongoing investigation into alleged instances of foreign exchange violations. The agency has sought further details and documents from cryptocurrency firms along with any information under the Foreign Exchange Management Act. Not just the ED, but the crypto platforms are being probed by multiple agencies, including the Income Tax Department. In June 2021, India's largest cryptocurrency exchange by volume, WazirX, was asked by the ED to explain transactions worth Rs 2,790.74 crores involving cryptocurrencies that are allegedly in violation of FEMA rules. In June 2021, the Mumbai GST Authority detected 40.5 crore rupees tax evasion by cryptocurrency exchange WazirX. The authority also recovered 49.2 crores in cash pertaining to GST evaded, interest and penalty after detecting significant amounts of goods and services tax evasion by cryptocurrency exchange WazirX. Other crypto exchanges and major investors in digital currencies are under the lens of multiple agencies, the Income Tax Department, the Directorate General of GST Intelligence, and the Enforcement Directorate. Considering the large number of stakeholders in this space, the clarification on taxation of cryptocurrencies is a welcome move. The Finance Ministry is also working on an FAQ on taxation of cryptocurrency, which will give nuanced clarifications on applicability of income tax on virtual digital assets. Section 149S has been added to the Income Tax Act via the Finance Act of 2022. What are VDAs used for? As VDAs are uniquely identifiable and irreplicable, they are used to help artists and creators protect their work. In addition, these can be transferred to another user and the new user becomes the only digital asset owner, making the creation valuable. The proposed definition of the term virtual digital assets appears to be very wide. VDA is proposed to mean any information or code or number or token not being Indian currency or any foreign currency which is generated through cryptographic means or otherwise, and provides a digital representation of value which is exchanged with or without consideration, with the promise or representation of having inherent value or functions as a store of value or a unit of account, and it includes its use in any financial transaction or investment, but not limited to investment schemes, and can be transferred, stored, or traded electronically. Non-fungible tokens and any other similar tokens are also included in the definition. How are virtual digital assets different from digital currency? A currency is a currency only when it is issued by the central bank of that country. In case of India, this is the RBI. If a virtual currency, be it a cryptocurrency, is recognized by the central bank, it is known as the central bank digital currency or CBDC. CBDCs are the virtual or electronic form of fiat currencies like the Indian rupee. Hence, a CBDC is a legal tender issued by the central bank in a digital form. CBDCs cannot be compared to the private virtual currencies that have proliferated in the last decade. Virtual currencies are not money, certainly not currency as the term has been historically understood. The government in Budget 2022-23 has proposed to issue a digital rupee or CBDC in the fiscal year 2022-23. According to the finance minister in a budget speech, everything other than a digital rupee or a CBDC is a digital asset created by individuals, and the government will tax the profits made during such transactions at 30%. Tax deduction at source will be levied at a rate of 1% on payments for the transfer of crypto assets above a certain threshold, that is rupees 10,000. Furthermore, gifts of crypto assets will be taxed in the hands of the recipient. Cryptocurrencies are untraceable, and many harmful elements in the society seem to be preferring this as a way of transaction. This has made RBI create strict regulations to scrutinize any transactions in NFT or crypto. This also increases risks due to fraud and discovery, since the transaction cannot be traced as easily as a normal transaction can. With higher rates and a legitimate and well regulated ecosystem, the RBI and the government can pave the way for crypto innovation and ensure its drawbacks are nullified. The central government may notify any other VDA through a notification in the official gazette. It can also notify assets not considered VDAs for the proposed section. For instance, VDAs do not include subscription to e-commerce, OTT platforms, and mobile applications. Digital gold, which is backed by an underlying asset, that is physical gold, is also not a virtual digital asset. Virtual digital assets may soon get a broader definition as the government brings more assets under its ambit. In a nutshell, the government may fine tune the definition of VDAs to cover any new product that emerges under the tax laws. Additionally, the CBDT has defined four primary virtual digital assets, that is Bitcoin, Ether, USD Tether, and USD Coin, for the purpose of tax deduction on lesser known cryptocurrencies. In various cases, the CBDT has defined who is responsible for deducting the tax. While the Reserve Bank of India has warned citizens about the risks with virtual currencies and virtual digital assets, there is no ban on buying, owning, or selling NFTs, cryptos, and other VDAs. However, business transactions in cryptocurrency are still not allowed. It can be invested, transferred, stored, or traded electronically. However, it cannot be used as a financial transaction or be part of any investment scheme. The Act also announced a tax on profits of virtual digital assets at 30%, regardless of it being held for the long term or short term. This tax cannot be exempted under any standard deduction, expenditure, or allowance. Tax on gifting of VDAs. VDAs are supposed to be included in the definition of property for the purpose of Section 56(2)(x) of the Act. The proposed amendment, as per which VDA shall be included in the definition of property, shall be effective from 1st April 2022. Accordingly, receipts of VDAs for no consideration or inadequate consideration prior to 1st April 2022 may not be taxable at all. The tax in case of gifting will be borne by the recipient. However, the ministry has also proposed to disallow or ignore any losses incurred by crypto investors. While there was some ambiguity on whether losses arising in the same year on one VDA could be offset against another VDA, it has been clarified that losses incurred from one kind of VDAs cannot be offset against the gains from any transaction involving any other VDA while computing tax. Thus, where a taxpayer earns a gain, say 100 INR on Bitcoin and incurs a loss of 10 INR on Ethereum during the same year, the loss on INR 10 will be ignored and the taxpayer will be liable to pay tax on 100 INR. If the investor or trade incurs any losses, these cannot be offset against any other income as per standard income tax rules. Withholding on payment of consideration has been introduced with a new section 194S which has been inserted in the finance bill. The bill provides for withholding tax at the rate of 1% on payment on transfer of VDAs. It appears that in case of transfer of VDAs on a crypto exchange, the responsibility to withhold falls on the crypto exchange since practically the buyers may not know who the seller is. The CBDT has also provided examples of cases in which a VDA is transferred in exchange for another VDA. For example, if two different cryptocurrencies such as Bitcoin and Ether are exchanged, both parties are considered buyers and sellers. As a result, both will have to pay the tax on the cryptocurrency transfer. If a VDA transfer occurs on or through an exchange and the VDA being transferred is not owned by the exchange, tax may be deducted by the exchange when it pays the seller. This mainly deals with situations where the transfer of a VDA is being made against money. In these cases, the guidelines also allow exchanges to facilitate such transactions to deduct tax. Tax on transfer of VDAs could create significant challenges in case of swap transactions where one VDA, say a Bitcoin, is swapped for another VDA, say Ethereum. Questions arise on the valuation of VDAs for the purpose of computation of the taxable income. This issue is further amplified since the trading price of VDAs on different exchanges may be different, and in some cases, even a single day fluctuation in price could be very significant. As of today, a tax of 30% is also levied on income from sources such as winnings from lotteries, betting, horse races, etc. This indicates that the ministry is viewing income from cryptocurrencies with the same lens as other incomes, which are largely in the nature of wagering contracts. Considering that individuals having income exceeding 1 million rupees are anyways taxed at 30% today, the proposed tax rate of 30% may not be negatively viewed by the industry. In general, the responsibility for deducting TDS has been placed on the exchanges, which will increase the regulatory and compliance burden. The exchanges must also disclose these transactions in their tax returns and keep a proper paper trail. However, both buyers and sellers would benefit from this because they can enter into contracts with the exchange for passing the responsibility to deduct tax on their behalf in VDA to VDA transfers or otherwise. Overall, the CBDT has successfully clarified several open issues that had been a source of contention in the professional community. However, several of the CBDT's recommendations, particularly those concerning the documents required, that is, agreements, challans, undertakings, etc., to be maintained between the transacting parties, may be impractical. To conclude, the RBI for a very long time has been opposing private cryptocurrencies as their implications on national security and financial stability could be serious. This recent step taken by the government recognized crypto as a legitimate asset class and crypto trading as a legitimate activity. But the higher rate of taxation clearly indicates that RBI wants to reduce the appeal towards this virtual digital asset. Thus, the announcement addresses the unreliability and concerns on the legal, regulatory, and tax status of cryptocurrencies to a reasonable extent. A well regulated crypto ecosystem will pave the way for the right environment for innovation. Considering the large number of stakeholders in this space, the clarification on taxation of cryptocurrencies is a welcome move. With this, we have come to the end of our discussion on the virtual digital assets and taxation on the same. Please do let me know if you would like to know more about current affairs topics in the comment section. If you like the content, please do like, share and subscribe to my channel. All the best. Jai Hind.